Let's be honest. Tax season can feel like you're trying to solve a puzzle, but the instructions are in a language you don't speak. But what if I told you that your entire U.S. tax return, no matter how complicated it seems, is really built on the answers to just 3 foundational questions? Well, today, we're going to decode them.
Right, so before you even think about your income or your deductions or any of that stuff, we have to start at square one. We need to establish your tax identity. So what are these 3 magic questions that basically define everything else?
Here it is. This is the blueprint for your entire tax return. First up, who are you according to the IRS? That's your filing status. Second, who's in your financial household? We call those your dependents. And finally, the big one. Do you even need to file in the first place? That's all about filing thresholds. Let's dive into that first question.
Okay, your filing status, this is the absolute bedrock of your tax return. It is the very first thing you figure out, and it sets the stage for pretty much everything that comes after, from the tax rates you'll pay to the deductions you're allowed to take.
Now, here's a really simple rule that surprises a lot of people. The IRS doesn't really care if you got married on January 1st or at 11:59 p.m. on New Year's Eve. For tax purposes, your marital status for the entire year is whatever it was on one single day, December 31st. That's it.
So just think about it for a second. When the clock struck midnight on December 31st, were you legally married or were you unmarried? Because that one simple answer sends you down one of 2 major paths for your tax return. And you can see right here where those paths lead. There are 5 filing statuses in total. If you are unmarried, you're probably either filing as single or, if you have a dependent, maybe head of household. If you are married, your choice is between married filing jointly or married filing separately. Now just look at how this choice impacts your standard deduction. That's the amount of income you get to subtract right off the top, no questions asked. For 2024, it's $14,600 for a single person, but it literally doubles to $29,200 for a married couple filing together. Huge difference.
So for married folks, the big decision is jointly or separately. Almost every time, filing jointly is going to be the better deal. It usually means a lower tax bill. But there's a catch. It's called joint and several liability. It's just a fancy way of saying you are both 100% on the hook for the entire tax bill, no matter who actually earned the money. The big drawback to filing separately is that you lose a ton of tax benefits. For example, if one of you decides to itemize deductions, list them out one by one, then the other spouse has to do the same, which can often lead to a much bigger tax bill.
So here's the bottom line. Your filing status is not just some random box you check. It is the key that can either unlock or completely lock away major parts of your return. It directly controls your standard deduction, the tax brackets your income falls into, and whether you can even get certain valuable tax credits. Getting this right is absolutely step 1.
Okay, let's move on to our second big question. Once we know who you are, we need to figure out who's in your financial household. The IRS calls these folks dependents, and believe me, they can make a really big difference on your tax return.
Now, it's not as simple as just listing everyone who lives with you. The IRS has 2 very specific, very distinct categories for dependents: the qualifying child and the qualifying relative. And for each one, you have to go through a checklist of rules to see if they count.
All right, for a qualifying child, you've got a 4-part test. First is the relationship test. Has to be your child, stepchild, sibling, or a descendant of any of them. Second, the age test. They have to be under 19 or under 24 if they're a full-time student. Third is residence. They have to have lived with you for more than half the year. And finally, the support test. They can't have provided more than half of their own support.
Now, for a qualifying relative, the rules are completely different. This is a much broader category. It could be an elderly parent you care for, an adult child living at home, or even a friend who lived with you the entire year. But the checklist is different. First, they can't be anyone else's qualifying child. Second, the income test. They can't have earned too much money. Third, the support test. This time, you have to have provided more than half of their total support. And fourth, they have to meet either a relationship test or have lived with you all year.
So let's just zero in on the key differences here. For a qualifying child, the big hurdle is usually that strict age test. But for a qualifying relative, the 2 big tripwires are the gross income test, meaning they can't make too much money on their own, and that support test, where you have to prove you were the one footing more than half their bills.
And that gross income test? It is an absolute deal breaker. For the 2024 tax year, that magic number is $5,050. If the person you're trying to claim earned just one single dollar over that amount, they generally won't qualify as your dependent. It doesn't matter how much you supported them, it's a critical number.
All right, we figured out who you are and we figured out who's in your tax family. Now it's time for that last foundational question. Do you even have to file a tax return at all?
For most people, the answer comes down to a really simple comparison. All you do is look at your total gross income for the year, and then you look at the standard deduction for your filing status. If your income is higher than that deduction amount, then the general rule is, yep, you have to file a tax return.
But hold on, that's not the whole story. There are always exceptions. For example, if you earned just $400 from a side gig, you have to file. But what's really important is the difference between must file and should file. A lot of people who aren't required to file absolutely should anyway. Why? Well, to get a refund of any taxes your job already took out of your paycheck, or to claim refundable tax credits, which can literally be free money from the government.
And that's really the big takeaway here. We need to reframe how we think about this. Filing a tax return isn't just an obligation to pay what you owe, it's also your one opportunity to claim everything you are owed. If you aren't required to file and you just don't, you could be leaving a serious amount of money on the table.
So answering these three questions, your status, your dependents, your filing requirement, that builds the foundation of your tax return. But that's just the start. That's the beginning of your financial story for the year. From this solid foundation, the rest of your story gets built piece by piece. This is where you add in all your income, from your W-2 job to that little side hustle. And it's where you find all the deductions and credits you might qualify for, like for education expenses or saving for retirement. This is how the basic blueprint becomes your own unique financial story. And that's really what it all boils down to. A tax return seems like it's just a bunch of boxes and numbers on a form, right? But what it really is, it's the official financial story of your year. Who you are, who you're supporting, and what you accomplished. So now, by understanding your filing status and your dependents, you've basically defined your fundamental tax identity. You've got the blueprint. You have what you need to start telling your story accurately and, hopefully, in a way that gives you the best financial outcome. Thanks for tuning in.